I mean, Warren, we've spoken about interest rates and inflation and wages and things like that. The obvious other key, I guess, variable or thing that's going on in the market that, is going on that people are concerned about or really closely following is what's happening with their house prices or the property market in general. Mm. With all these moving parts at the minute, how do you see that playing out, and what do the forecasts look like for the sustainability of prices where they've been?
Yeah, well, it's the property market's at the coalface of the adjustments going on in the economy. There's no two ways about it. And I think we should all be penciling in some sort of a drop in residential property prices, if not all property prices, in the next 12 to 18 months. The issue for me is the extent of that drop. And then also, is it a broad-based deflation of prices due to higher interest rates where everyone's affected, or does the market become a lot more idiosyncratic? And the reason I say that is we've had, again, extraordinary circumstances with ultra low interest rates, and you could even argue quantitative easing, meaning there's a lot of money in the system, so access to capital was pretty good. And what I observed, and what I've been telling people for some time now, is that through the pandemic, through 2020 and 2021, everything went up. It was everything from a shack in Bundaberg to a mansion in Toorak. And that was a repricing of the whole housing stock and probably all property on the back of very low interest rates, both in the case of the cash rate, but for things like industrial and commercial and so forth, the long-term interest rate. Now, that story's radically changed this year with the inflation that's come through on the back of the strong economic recovery. And I think thus far, I am amazed at how well asset prices have held up. Mm-hmm. So as you drain liquidity from the system, you see the most speculative and tricky of investments suffer. So crypto, leveraged tech investments have been clearly impacted. But blue chip or core equity markets are actually, down 10, 15%? It's not bad given the magnitude of how the environment's shifted. And of course, we're now starting to see residential property anyway come off in Sydney and Melbourne, top out in Brisbane and Perth. And the surprise performer's actually been Adelaide, but I think there's some signs there that that's running out of steam too. Now, with property, there's always the all-present impact of funding costs or interest rates, and maybe the availability of credit. But on the other side of the ledger, there is fundamentals based on income, supply and demand. And of course, those factors then become more, to use an equity investing term, stock specific. In Australia's case, we've got very different state economies. But even within that, we've got different types of residential, whether it's apartments and houses, whether it's regional or urban or inner city. And I can see I'm not as bearish on property in the next 12 to 18 months as some. So the consensus that sits there now as we're entering the back half of 2022 with the RBA's intent pretty clear is that residential property prices across the nation will come off between 15 and 20% over the course of maybe 18 months, peak to trough. And, different markets will perform around that. I think that's too much. And I'll show you some of the metrics, but the metrics for me suggest that on a modest tightening cycle with a cash rate going to 3, as is generally expected by most now, that we should expect to see maybe a 10 to 12% fall. And the reason I'm more optimistic is A, I don't think the economy is going to roll over. B, there's a lot of liquidity, and I think we're still seeing up until the latest data, the financial institutions are still writing a lot of mortgages, even though it's not growing, but it's not collapsing. But most importantly, we have got some inflation and wages are moving. And of course, a 10% fall in house prices, if wages go up by 5, is a real fall of 15%. Mm-hmm. And this has to be all looked at against the backdrop of the fact that Australia is always undersupplied for housing. The phenomenal performance through the pandemic, even in the most stressed markets, inner city apartments in Sydney and Melbourne, where they lost all those visa holders, the temporary visa holders, the backpackers, the students, even those markets didn't do too badly because we don't have an oversupply. We saw in the GFC what happens when you build too much. You saw that in Spain. You saw that in parts of America. You're seeing that in China now, where they're destroying whole developments of apartments before they've even been lived in. Now, we never get that in this country. Now, there's lots of problems that are associated with not having enough housing, and we can talk about that at length. But in terms of what that means for pricing, is that it's rare to see big sustained falls. So that's what I'd call my starting point. I think there's going to be some markets. So, for example, I've got some familiarity with the Sunshine Coast. And when I say some, I do mean some, as opposed to a lot. But my guess is that we've seen some substantial population movements, particularly out of Victoria into Queensland. I think the Sunshine Coast has been quite appealing, and they've got a massive shortage of housing. So I can see house prices in Australia falling 10% and house prices in the Sunshine Coast not falling. I can see, 3-4 bedroom family homes in the suburbs of most of the capitals falling by less than, say, holiday homes. Look, I'm not sure. I'm not going to go into that level of detail, but I'm a little bit more positive. But of course, this is all predicated on a pretty good outcome. And when I say good outcome, this sort of narrow and uncertain path that central banks, the RBA, even the Fed are talking about how to get this inflation under control without a major recession. That's the likely outcome. And even with that view, as we've discussed in previous, I think there's going to be some more interest rate increases in 2024, and that's going to stop a decent rally in housing at the very least. So I think where you start to get a little bit negative from my perspective is that house prices are going to take a dip, and they're probably going to remain problematic for a little while. But we will get back to a point when the economy is back on an even keel, back to a sort of a more normal operating state in 3 or 4 years' time, where property prices respond to not just those underlying supply and demand fundamentals, but the overall market responds to income fundamentals like it did in the 1980s, 1990s, where you can expect house prices to go up a little bit more than inflation. And so that's, I think, a more positive view. And then if you take that backdrop, then I think the other thing to note in this analysis is investors are a third of the market. Through the pandemic, we've accumulated excess savings of 200 to 250 billion. That is savings over and above what we otherwise would have. And that money will be put to work eventually. And I just have this sort of funny feeling that investors could potentially play a big role in this market in the next few years. And if we do see some difficulties in the global economy, if equity markets do start to come under some stress, property is quite an attractive place to park your money. More attractive than crypto, funnily enough. Even gold doesn't have the same characteristics of property. And this isn't an Australian thing. All cultures love property. And so I've got a funny feeling there's going to be a bit of money flowing into the market outside of just your normal demand for property for your normal reasons. So I'm constructive in an environment where we certainly shouldn't be bullish. But I think the big thing that everyone wants to know is, how does property fall by 30%? Our biggest vulnerability in this economy is property, and it's the bank's biggest vulnerability. Our banks have the most assets devoted to property of any banking system in the advanced economies. And as a former chief economist of one of the major banks, I did a lot of work on this. And it's where our economy comes under real threat, is if the banks start to come under stress with their property lending, then they'll be unable to lend to businesses. What is that point? Well, that point is a fair way away. It literally is a combination of unemployment up near 10% and prices falling by 30 or 35%. The average LVR in the banking systems is between 40 and 45%. Yes, there are a lot of more marginal borrowers out there and a lot of first home buyers, but it's that core that we really worry about for calamity. And we're miles away from that. Our best chance of that happening is if we don't raise rates now, if we do let inflation become a problem, and if we do have a few things go badly, such as geopolitics or something. I think these are all very low probability events. So I'm not worried about that. And I'm not a buyer of the view that property is going to fall 20% or 25%, which I think is a bit of a debate on Twitter at the moment, or has been, just because it's a serious asset class in this country. The commercial property, a little bit trickier. Lots of changes there. Industrial is still trading very well, apparently, despite valuations should be down 10 or 15, but it doesn't seem to be trading that way. I'll be careful. The commercial side or the industrial side or the non-res side is often where we is historically in many countries where you get into trouble, because that's where you can get some exuberance, and maybe that exuberance is ahead of us potentially if this economy proves to be stronger and so forth. So, but at the moment, I'm constructive property.
It sounds like one of the questions I did have was around the banks, and I think you've answered that, articulated that for a while there, probably the equity markets, when it sold off the banks 20% at some point, was starting to fear that there would be this sort of contagion effect to the banks with bad debts and things like that. The banks are in a lot better shape than they were in the GFC.
Yeah, and the GFC, again, the stress came through, the commercial channels, whether it's related to commercial property or providing lines of credit to institutions that were not doing well. And the banks, the GFC resulted in a lot of bank regulation, which I saw up close. And I wouldn't say our banks are bulletproof, but the regulation of banks all around the world has meant that they hold a lot more capital and a lot more liquidity than they ever had before. In fact, you could argue that that's seemingly costly because it's expensive for them to hold all that, and therefore they charge that out, which any business does. But putting that to the side, it does mean that if there is a stress event, they're going to be better placed. You really do need to get into the realms of a massive shift in the supply of money, which at the moment, the only feasible way you could see that is through inflation and interest rates going to very, very high levels. And I'm not talking about sort of 4, 5, 6. I'm talking about 7, 8, 9, 10 on cash rates and bond yields. And I just don't think that if that calamitous type scenario is playing out, that central banks would allow it to. They would start to see the risks of that sort of threat to the core banking system has been greater than letting inflation hang around for a while. So, yeah, at this stage, it's all about what we come to call black swans. The low probability, high impact event. We can't ignore them, of course. But at the moment, I think we're still pretty well positioned, given the range of sort of outcomes that we've been talking about is likely.
Do you think you're still going to see? I mean, one of the questions I've always had is how much does the RBA really care about housing prices? I mean, how high on their list of agenda items is that they go, well, do we really need to see house prices drop by 20% for housing affordability and the sustainability of the economy, or do they go, well, if inflation was at 2%, so be it?
Yeah, I mean, one of the innovations in monetary policy in the last couple of years, which I didn't really like, was that they've been quite explicit to say that it's not their job to worry about housing. Which to some extent is right, and certainly affordability and so forth, particularly if that affordability is driven by an undersupply, which I think most would agree is the case. They can't build houses and they can't rezone. And we know all the reasons why we have an undersupply is related to complex regulation and zoning, et cetera, et cetera. So, but that being said, the housing market is how interest rates affect the economy. The old idea that a change in interest rates takes 12 to 18 months to work its way through the economy. Well, I can tell you, in the first 6 months, it's working its way through the housing market. So they can't ignore that. and they shouldn't, in my view. And I think them coming out and saying they don't care about housing or whatever terminology they used was wrong, because they do need to, that market starts to really destabilize for whatever reason, even if it's for a reason outside of their control. That's going to affect their monetary policy. So, look, in terms of where we've been, I think they showed. I don't think they should have taken rates as low as they went. That's nice in hindsight. I think the extent of the housing price surge that we saw has surprised everyone. I don't think there's anyone who, in the middle of 2020, could have anticipated the extent to which house prices went up everywhere, including the RBA. It was alarming. For that reasons of affordability and other reasons. And by the same token, they sort of can't worry too much about what I'd say is the first 10 to 15% fall in prices, but they'll certainly worry about the next 10 to 15, if you know what I mean. So they do certainly take it into consideration, even if they don't want to tell us that. But they don't see it as their job to fix up the structural problems.
Do you believe then, one last question is, do you believe then in the, I call it the wealth effect, which, you know, when house prices are going up and people just feel psychologically safe, I suppose I'll use the word, to either spend money or borrow money and use it on renos and holidays and cars and things like that. I mean, how much do you attribute the reverse of that happening now in terms of that having a really profound impact on the economy in the next 6 months?
Yeah, no, it's a good point, and I should have made it. Is that I don't believe in the wealth effect, but it's there. And what I mean by that is that it clearly plays a role at the margin, but I think it's overstated. I think I've seen a number of economists in the last few months say, oh, the economy is going to fall because people are going to feel less rich because their house price has gone down. I have a much more pragmatic approach to the way Australians view house prices, and that's that we stop talking about them when they're going down. Because they are what they are, and that's a 30-year asset. And
that's right.
Australians are smart, right? We've been great with the economy and finances since the Hawke-Keating economic revolution, and that's everything from just understanding markets and the economy through to superannuation and long-term assets because of compulsory super. So, you know, we might all like to, you know, have a chuckle when prices are going up by 10% a year, but we just sort of go ghostly quiet at Sunday about house prices when they're falling. And we saw that in Sydney and Melbourne in particular in 2017 to 19. They fell 17%, 18%, I think. And it was just a case of, okay, well, you know, I'll fix that up. And, you know, that'll fix itself up in the next 8 years or whatever. So look, the wealth effect's overstated. It's there. And the other thing is that there has been a lot of renovations. I do believe that's part of a wealth effect. I think wealth, what happens with, you know, this is what's the appropriate capitalization of your property. And that's been around for generations, thinking about what the structure should be sitting on the land value. And of course, if the land value goes up a lot, you're more inclined to do a renovation. But I think the motivation for the renovation has been driven by the pandemic. It has been driven by a change in our housing preferences. Because as I've said to you before, I think that's one of the more profound and lasting things to come out of the pandemic is the way we think about housing. And that's not something that's going to go away quickly. And that drove the renovations. The fact that house prices went up by, you know, 20 or 30% helped people sort of take the step to go and fund 200 grand worth of renos or whatever it was. And there has been a renovation boom, but I don't see I think we're seeing a big adjustment going on as we speak. And I don't see that following through into or being the driver of a big weakening in consumption. The other thing to bear in mind is that house prices are one thing, and there's the real housing industry that sits all behind this, and that's the construction side, obviously the broking and all that sort of side. That will slow. There's no two ways about it. But again, you know, I don't think it's going to be the big disaster that some are speaking about. The pandemic has meant that the pipeline of residential work's pretty solid. So building approvals have come off a bit, but they've held up okay. And so I think the construction side and employment around residential construction is going to hold up. I think the renovation work is going to continue because I think it's motivated by longer term things. And I think that's really important for how the housing affects the economy and the transmission of monetary policy. And hence why I don't think a 3% cash rate will get the job done. You know, the construction of apartments is, I think, the big unknown. So So what we've seen is the eastern seaboard of Australia experienced an apartment building boom between 2013 and 2017. And that's actually been shrinking in terms of activity ever since. The pandemic has had no noticeable effect on that broader cycle, construction cycle. What happened in the pandemic was a surge in demand for new houses as opposed to apartments. And that's actually come right back in terms of approvals, but it's still, the number of houses approved in the month of June was equal to the highest levels prior to the pandemic. So it's still at high levels. But I think the big uncertainty for the housing market is where to from here for apartments. And I think it actually is a critical part of housing supply. I think with immigration picking up again, there's no coincidence that the very high rates of immigration that happened in the sort of 2008 and onwards period also coincided with a surge in apartment building. And so I think the apartment side will actually pick up. It's just a matter of how quickly. And it might, in this environment where rates are having to go up to sort of slow down inflation and so forth, it might take a few more years than it otherwise would. But so what I'm getting at is that I think you get the let's call it a 15% drop in house prices over the next 18 months. I think the construction side will slow down, but it won't tank. I think employment in the industry probably won't grow as much, but it won't fall a lot. And I think we're actually going to see another pickup in construction in 2 or 3 years' time, as we always do, the cycles.
Just quickly, Warren, just on you mentioned earlier about the different trends in, eastern states, Brisbane, Perth sort of stabilised and SA, Adelaide currently, I guess, lagging behind that. Is there something more in that, or is it just purely timing and South Australia is just slower to respond, but, it's coming at the same rate?
Look, the South Australia story is a bit of a mystery to me, and I want to do some more work on it. It obviously performed well through the pandemic with a lot of government handouts. That's not being unfair, but that really did help the smaller states like Tasmania and South Australia. I think South Australia and Tasmania need a very strong, collaborative, government-led industrial story plan in this new world. And it is happening in South Australia with defence industries, and I suspect some of that is part of this story. South Australia is looking better than it for a while. Like I'm talking, South Australia got hit pretty hard by the loss of manufacturing in the last generation or two.
Yeah.
So since the last 30 years. So I'm sort of quietly optimistic of a turn there because it's such a sort of a great place. There's such a good platform that it's struggled to get traction in the last 15 years, and it could be happening, but the government needs to be very clear and working with the federal government on an industry plan. The state that stands out the most for me is WA. So it was only just recovering from the mining downturn in the year or two before the pandemic, and that included house construction and house prices. WA was completely out of whack with the rest of the country. They were just getting their mojo back as the pandemic hit. So I actually am very positive WA, and that's not even with a strong mining story. I think there's obviously a lot of money pouring into the place because of high commodity prices, but there's no mining investment boom going on there. I think it's a housing story, and that's after a very difficult 10 years before the pandemic of wind down. And Queensland was a little bit the same as WA. So it's, for me, the big one where I'm watching is Victoria. So Victoria and New South Wales led the cycle ahead of the pandemic. And a lot of that was housing construction as well as other construction. But what we've seen in the pandemic is Victoria's lost a lot of people. They've had, I think their population might even be lower now than it was at the start of the pandemic. And that's disastrous for economic activity. It's the headcount matters, and the growth of headcount matters. And those people have probably pretty much permanently gone to Queensland or wherever. So where to from here for Victoria? I think that's the big unknown. And New South Wales, I'm sort of, it probably won't be a super decade like it was prior to the pandemic, but I think it will be okay in Sydney and broadly in New South Wales. So growth states, WA, Queensland for sure. South Australia, question mark, but optimistic. Victoria, question mark, but not optimistic. New South Wales, middle of the road, but is often middle of the road because it's the biggest state. And Tasmania, I just can't can't get clear visibility of that. But I think it's similar to South Australia, but not as promising in the sense that they really do need a government-led plan. And, I'm a markets guy. I don't think governments should do everything, but those smaller states need a plan.
Yeah, cool.
More than the New South Wales. So let me share some charts, and I'll quickly, in 6 minutes, do the why I'm not as bearish on property. So this is the view at the moment. This is quarterly house prices. This is using ABS data. The falls are starting now, and the really biggest falls are going to be in the second half of this year, i.e. now, and then they'll moderate. And I've only given a year there, but just to give an idea that we've got to expect a repricing on these higher rates. That's the message. There's no real construction standout, and this is work done except for in the apartment side. And as I said, that story's been going since 2017. It's not a pandemic related story. And I don't see that being a big sort of downside from here. So I just don't see a big excess supply of housing. If anything, we're running under supply as we usually do in this country. The pipeline is good. There's been constraints on construction everywhere, and res as well. So, I mean, these data are also cyclical, so the story can change. But at the moment, there's over almost 110 billion in Q2 of residential work being done, and a pipeline of probably another 50 billion. So, we've got. I'm not worried about a big downturn in housing construction. That's your recession story, and it's just simply not sitting there for right now for me in the next few years. I've talked about the approvals. You can see the apartment approvals versus the house approvals, so you can get an idea of the pandemic story being a house story. But I think the more important one is if you look to the chart on the right, the number of approvals has come right down, and this is data up until June, I believe. The value, though, has not fallen anywhere near as much. And this is the inflation story. This is the cost of construction story. So the number of approvals, and admittedly, the yearly numbers are sort of peaked to where we are now. They're down 17%, I believe. But the value of approvals is only down 4%. So there's a lot of money in the system. So yes, the construction sort of industry is under pressure because of the shift in the costs and the profitability hit, but that's a short-term play. If you can survive this period, then they can get through it. There's work there to be done. This is the mortgages each month in dollar values, and this number is showing that whether you're an owner-occupier, what I call the changes, which is essentially owner-occupiers, ex-first home buyers, they're still taking down sort of 16 billion a month, as they have for the last 18 months or so, or since sort of May 21. And the investors, they're starting to come off a bit, but they're still prominent. They were late to the game. It's the first home buyer that's been in retreat for a year, and you can see what the first home buyers do, and that is that they are a small part of the market until they have a burst of activity, usually on the back of low rates, falling prices, or government incentives, i.e. affordability. So they're likely to be a bit of a non-player in the market for the next few years. It's just whether I think what the investors do is going to be key. But so far, so good. I'd expect that to fall at least 25%. So the mortgage market will get a lot tighter and tougher, but we're not seeing it as yet. That's those new mortgages versus house prices in annual growth terms. And you can just see that, and it makes complete sense when the total value of new mortgages changes, the house price changes. And at the moment, the numbers to June for new mortgages, they're only down 2%. Or 5%, I think. So they're not telling us that there's a big collapse in housing. I mean, I think it will go down into negative territory over the course of the next 6 months, but the new mortgage numbers are worth watching. But there's no construction hit. So there's the household debt service, which I've shown before about the cost of interest payments for households, how they're going to go up a lot with the RBA rate hikes. What I've done here is it's the change in that debt service on the right-hand side, inverted, just to make it as complex as possible, versus house prices. Now you can see that, and it makes sense. It's as interest rates go up, house prices go down, etc. But it just shows you can try and triangulate the magnitude of the house price fall. And On this, there is a big hit. So the price movement could be quite sudden over the next 6 months, but it's still telling you sort of, negative 10%. But we can't be too precise with these things. But it's not telling us that we're miles out of the ordinary. We're going to take a short, sharp hit, probably a sharper hit than we've ever seen. But if house prices fall 10 to 15% over 18 months, that's pretty bad. That's as big as we get in this country. And then this is again, just to complicate it, the change in the real house price versus the change in the real mortgage rate. And again, you can see over a longer time frame the strong relationship. And what I've got here is a forecast for the real mortgage rate based on both, RBA and inflation, which I've been talking about. And you can see that it's not necessarily a sustained fall. So real mortgage rates do go up and they do have an impact, but then they come down again as inflation moves around and as interest rates, as the RBA maybe get some flexibility. So I'm just trying to get the idea that we're not in for something we've never seen before. It's probably going to be pretty severe, but it's not out of the ordinary. So I think that's the message as of the start of the second half of 2022, as we're heading into the spring selling season, that it's going to be a tough spring selling season. But I'd just be careful against, as I always say, about the doomsayers and those calling a disaster. Just like the whole economy, we're going to have, I believe, general resilience mixed up with pockets of distress, and that's not going to be pretty. The media is going to give the distress a lot of attention, but then the smart money is sitting there thinking about what does that resilience mean, and is this an opportunity to invest?
Excellent. Thank you for your time, Warren, today.